Sometimes a story hits the market that just stops everyone in their tracks. A single bank branch, a fraud in the nine figures, and a stock that just completely went into freefall. The IDFC First Bank case, well, it sent some serious shockwaves through India's entire financial sector. So in this explainer, we're going to break it all down. We'll look at what happened, how a fraud of this magnitude was even possible, and probably most important for many of you, what it all means for investors. Right off the bat, the headline number is just staggering, 590 crore rupees. And let's be clear, this wasn't some rounding error or a minor system glitch. No, this was a massive, deliberate fraud that somehow went completely undetected for months, all centered in one single branch up in Chandigarh. And the market's reaction? Oh, it was swift and it was absolutely brutal. The second this news broke, the stock just plummeted. It hit the 20% lower circuit breaker. That's a mandatory trading halt, by the way, designed to stop a total collapse, and it did it in a single trading session. That one-day crash, it wiped out nearly 12,000 crore rupees in shareholder wealth. Gone. So, here's what we're going to do. We'll dig into the true impact of this fraud, we'll dissect the anatomy of exactly how it was pulled off, analyze the market's gut reaction, and then lay out a clear playbook for investors trying to navigate this. So you might be thinking, 590 crore is a lot of money, but why was it so incredibly damaging for IDFC First Bank specifically? Well, it's all about context. For a bank of this particular size, that number isn't just a loss, it's a critical blow. And this is where that number really truly hits home. Just look at this comparison. The fraud amount, 590 crores, is actually larger than the bank's entire third quarter net profit of 503 crores. Just let that sink in for a second. A single rogue operation in one branch didn't just cause a loss, it literally erased more than an entire quarter of the whole bank's earnings. At its very core, this was an insider job. The bank itself came out and confirmed that its own employees at its Chandigarh branch were the ones carrying out these fraudulent transactions. And they were specifically targeting accounts that belonged to the Haryana state government. So the real question is, how did they actually manage to pull this off? You'd think for a fraud this big, it would involve some complex cyber attack. But the mechanism here was surprisingly low-tech. It relied on old-school physical documents and what appears to be a complete and total breakdown of internal checks and balances. So let's walk through this multi-layered process. First, they used forged signatures. And get this, one of them was from an official who had already left his post months earlier. Second, they submitted fake debit notes that were missing basic required details. An immediate red flag that was somehow just missed. Third, they colluded with people on the outside to route the money, making the trail much harder to follow. And finally, funds that were supposed to be in secure fixed deposits were diverted to much more accessible savings accounts. And look, don't just take my word for it. In its own official regulatory filing, the bank confirmed it was an insider threat, stating, and I'm quoting here, "Prima facie, unauthorized and fraudulent activities have been carried out by certain employees at a particular branch." This wasn't some external hack. The call was coming from inside the house. But here's what might be the single most troubling part of this entire affair. The fraud wasn't caught by the bank's internal audits. It wasn't flagged by their fancy surveillance systems. Nope, it was discovered by the victim, the Haryana government itself, when officials started noticing mismatches in their own account balances. The critical point here is that the bank's own safety nets, they completely and utterly failed. And of course, this colossal failure in corporate governance led to an immediate and severe reaction from the market, wiping out that staggering 12,000 crore rupees in just a couple of days. Okay, let's really break these numbers down. The share price collapsed by 20%, we know that. But look at that bottom line. The entire fraud, as huge as it was, amounted to just about 1.4% of the bank's total net worth. This is the crucial insight here. The market wasn't just reacting to the financial loss itself, it was reacting to a catastrophic failure of trust and governance. That 20% drop was driven by fear, not just the fundamentals. So, with the markets in turmoil and a full-blown crisis unfolding, the regulators, the government, and of course the bank itself, they all had to spring into action. This timeline really shows you the rapid escalation, but notice that crucial gap. The forged signature belonged to an official who left all the way back in October, but the bank wasn't even alerted until the following February. On the 21st, the bank discloses the fraud. By the 23rd, the stock has crashed and the Haryana government de-impanels them, basically firing them as their banker. And just one day after that, arrests were made. The official responses were pretty decisive. The RBI governor moved quickly to calm the wider market, confirming this was an isolated institutional failure, not some kind of systemic risk to the whole banking system. The Haryana government, though, acted swiftly and cut all business ties with the bank. And the Anti-Corruption Bureau moved in, arresting 4 people and starting the really complex work of trying to trace the money. Now, internally, IDFC First Bank went into full-on crisis mode. They suspended the officials involved, they brought in a big name, KPMG, for an independent forensic audit, they filed a criminal complaint, and they started the process of trying to claw back those stolen funds from the other banks where the money ended up. So, all of this brings us to the question that's probably on every investor's mind right now. After a 20% crash, is this a total disaster to be avoided at all costs, or is it a potential opportunity? Let's analyze the playbook. Well, your strategy here really depends on your time horizon. For short-term traders, the volatility is just way too high right now. The best action is probably to stay on the sidelines and wait for those KPMG audit results. For long-term investors, however, the rationale looks a little different. The fraud, while very significant, is still less than 2% of the bank's net worth, and its core business franchise, well, that's still intact. And for those of you already holding shares, selling in a panic simply locks in that 20% loss. Now, if we zoom out for a minute, this case offers some really critical lessons for the entire banking sector. It exposes the unique risks of managing these huge government accounts, the lingering vulnerability of physical checks, and, maybe most importantly, how easily standard maker-checker controls, where one person initiates a transaction and a second person has to approve it, how easily that can be bypassed by internal collusion. It is a stark warning about the challenge of oversight for any rapidly expanding private bank. And that leaves us with the final, crucial question. Was the IDFC First Bank fraud a contained, one-off institutional failure? Or is it maybe the canary in the coal mine, a real warning sign of deeper governance issues brewing within India's fast-growing private banking sector? That is the question the market is going to be watching very, very closely.